Hello, and welcome to the Bloomberg Canadian Finance panel discussing the shift to renewable power. This has been a year of stresses on power grids and consumers when it comes to energy prices, weather, supply chain issues, inflation. So we're fortunate to hear from two power gurus who have been thriving and finding opportunities and navigating challenges in this push to decarbonize. We have Wyatt Hartley, Managing Partner and Chief Financial Officer of Brookfield Asset Management's Renewable Power and Transition team, which has $67 billion of assets under management and about 21 gigawatts of generating capacity. And Jeff Norman, a Chief Development Officer of Algonquin Power, a utility and renewable company with more than 16 billion of assets and about 4 gigawatts of generating capacity operating or under construction. So we have 20 minutes and we're going to dive right into it. And one thing that's become really obvious this year is that it's getting harder to keep the lights on, whether you're in Tokyo, Europe, or the US. And so as a developer, when you're thinking about these challenges, you know, renewables are the first to be blamed when anything goes wrong. You have weather dependent resources. As a developer, are you thinking about reliability and resiliency differently? Like, can you do anything to enhance it? Wyatt, why don't you go first?
Yeah, so first off, thanks for having us. A pleasure to be speaking with you today. Look, I would say overall, the backdrop we're seeing for renewables and clean energy is as strong as ever, irrespective of some of the issues you mentioned. And really that's driven by three things in our minds. One is that the drive towards decarbonization is as strong as ever. That's both from a government perspective, but also increasingly from corporate and commercial actors. Secondly, the economics are getting even stronger when it comes to wind and solar. And that's really on the back of the competing generation being thermal has gotten more expensive in these gas price environments. And then third is really kind of on the back of energy security, just given some of the concerns that have come out of what's occurring in Europe. And so ultimately, you know, irrespective of some of the events you mentioned, that we really see that the trends towards our business and clean energy and decarbonization are as strong as ever. In terms of the questions around reliability of grid, we fundamentally have believed as a business that the solution to a decarbonized or cleaner grid will come from multiple different service offerings that you can provide. You can't build a clean grid entirely off wind and solar. And for us, that positions our business really well because we have that suite of products and services. You know, we have our hydro business, which we've owned and operated for over 30 years, but now we also own wind and solar, both when it comes to wind, both onshore and offshore. And on the solar side, we own both utility scale and distributed on a distributed basis, as well as, you know, we also own storage you know, in the form of pump storage, but not more recently, we've also been adding batteries. And, you know, for us, the broader decarbonization of the economy will also continue in other services like carbon capture and sequestration or potentially green hydrogen. And so the ability to bring a broader suite of solutions and products to the market to provide a solution to some of those grid reliability issues that you mentioned is going to be key. And we think that, you know, our business is very uniquely positioned to be able to take advantage of that and add that grid reliability going forward.
And what about you, Jeff? I mean, Algonquin has a history of initially developing hydro, and you're doing more renewables and renewable natural gas, and I think even getting into hydrogen in the U.S. How do you put the pieces together? Did you have to like pivot in any way with these lessons learned from just this year alone?
Yeah, no, it's a great question, Naureen. And I would say similar to Brookfield, that full suite of generation and storage is what you really need to solve the problem. And so we view ourselves right from our history of a startup in the development space that's moved into owning generation and owning distribution systems, gas, electric, and water, that it's looking to what the problem is and how our skill set can be used and applied to solve that problem. And the solutions are getting better and better all the time. So it was wind and solar initially, with hydro as being a great historic and and great asset to own going into the future, filling its role. But we're seeing that expand. And so RNG is going to be part of the solution. Hydrogen is going to be part of the solution, but different forms of storage are definitely part of that. And so in order for us to get the grid reliability and to make the energy transition we need to keep our aperture open and consider those alternative forms of generation and storage.
So the US last month passed the Inflation Reduction Act, and it earmarks more than $300 billion on clean tech and clean energy and climate initiatives. Did that in any way supercharge kind of like your outlook, like your pipeline, and how?
Yeah, no, it's extremely exciting. I think there was lots of rumors, and we thought we were going to see this type of support out of the U.S. Last year at the end of the year, and then it was waning for a while, and I think people were starting to get concerned. But the Biden administration has come through with a great package that is not only going to incent the build out of generation, but it's going to incent some of the missing components that are required to implement that. So we are extremely excited about what lays in front of us. And we've got the largest economy in the world putting forward just a massive package to drive opportunity and drive the transition which so needs to take place. And they've done it in such a large commitment that it's allowing equipment vendors, equipment suppliers, new battery suppliers in order to make the commitments that they need to meet some of that demand. And so I see just a great decade of growth. There's going to be some challenges because we're trying to do this at a very rapid pace, but it's going to be a fantastic decade of growth.
So Wyatt, for you, in this fantastic decade of growth, I mean, are you doubling down on your pipeline? What are you doing? Like, what does that look like in terms of gigawatts or money spent?
Yeah, look, we're in a very fortunate position here at Brookfield in the sense that we, even before the Inflation Reduction Act was passed, we had been significantly scaling up our development pipeline in the U.S. We have recently acquired a solar developer at the beginning of this year, solar and storage, I should say, 20 gigawatt development pipeline. We have been meaningfully adding to our distributed generation business in terms of buying both operating and development pipelines, all under an investment underwriting that didn't factor in the Inflation Reduction Act. And now, of course, with the bill passed, that just, to use your word, supercharges our pipeline, where we have, on the back of some of that activity, 35 gigawatts of development in our pipeline across wind, solar, storage, that the investment case for those products increases. Because going back to the second point, or the second of the list of the three things that I said that was driving clean energy, the economics were good for wind and solar on an unsubsidized basis. If you add a subsidy, of course, the adoption even increases more meaningfully. And so we definitely expect to see the development pipeline we have get pulled forward because the economics will just make more sense in that regard. And then to Jeff's point, especially on the storage side, with the standalone credit for storage, that's also very meaningful because we have been building storage out across the U.S. It's just generally adjacent to our existing facilities where we already have interconnections. We have the other existing grid infrastructure that allows us to kind of reduce the capex cost and only pay for the battery, and that's what's making the economics make sense. But there was limited number of those scenarios where the economics were making sense. But with the subsidy, that does two things. One, it creates that economic incentive, or it bridges that economic gap to make a lot of those investment opportunities more compelling for the offtake. But secondly, it allows the sector to scale on the back of that, which should then over time reduce costs as those supply chains benefit from the efficiencies around scale and driving down unitary costs. So it will kind of also build out over time. It will mean that economics around batteries will improve over time, and they should be able to stand alone without the subsidies. So we're very, to repeat something that Jeff said, our optimism around the development that we expect to do in the U.S. is very meaningful on the back of this legislation.
So when you said that you would pull forward projects, you have a 35 gigawatt pipeline. were these projects that would have taken 5 years before, and now we're going to take like a year? That just throw out some random numbers, but
Yeah. Yeah, look, I don't think we're all of a sudden going from 5 years to 1 year, but yeah, definitely. Like in all of those projects, I would say, we had in the case of the urban grid or the solar developer we acquired, we had 6 gigawatts that we, just where it sits in terms of securing permitting interconnections, that the expectation that would be built out over a 5 to 6 year period. I think that, just given where we are now, that's probably being delivered over the next 3 to 4 years. But also that broader, there was an additional 14 gigawatts of both storage and solar that was kind of more early stage to that. Then that should also bring that forward. So it still will take time for permitting, interconnections, et cetera, to get done. So it's not next year, but ultimately it is definitely an acceleration of and an increase in the amount of development we do.
So, Jeff, where are you building? Like either by country or power grid? I mean, you have to be very cognizant of the local factors to build these projects these days.
Yeah, no, it's so right now where we're under construction is we just completed a 177 megawatt project in Saskatchewan, contracted with Sask Power, and we've got a number of projects in the U.S. under construction in PJM and MISO, both solar and wind. But I think more importantly is where we're placing our bets going forward, and we have been expanding our greenfield development activities for many years now, and so the Inflation Reduction Act is fantastic because it really does prove that investment that was made and the economics that we expected to work without the extension are now supercharged or at least in a better place. Now, I think we all have to be realistic in that the benefits of the Inflation Reduction Act can't go to one party. They're not going to just go to us. We need to share those with our customers, and we also need to take and share some of that with the equipment supply. And we're seeing that those price dynamics kind of play out. But we are still excited about advancing the projects that are in the right stage in interconnection within PJM, and we're excited about continuing to move forward our early stage pipeline in PJM that will be a little bit more delayed because of some of the pressures on that interconnection. And we're excited about MISO, and we're advancing projects in California as well.
Yeah, the interconnection queue is perhaps one of the biggest issues right now. I mean, yesterday, MISO around the Midwest to the Gulf Coast, that grid said that their interconnection queue is now over about 200 gigawatts, and it was like around 70 something or 80 last year. So that's a massive acceleration. The Midwest and Mid-Atlantic have a ton of fossil fuels still in coal. So when you're talking about delays, Jeff, what kind of delays were you expecting projects to come on next year and now it's going to take 3 years? What are you seeing, and why? I'd love to hear your thoughts as well after.
Yeah, no, so I think to put it in perspective, there is a massive amount of development going on across the US and North America. And so there's now more terawatts of generation in the interconnection queue than there actually is in the ground in the US. But so having projects that have been are at the earlier end of that queue line and in places where they're going to advance more quickly is important. So quality of pipeline is a big deal as we push forward to advance. I think specifically to your question, Naureen, if you just look, I think between 2000 and 2010, it used to take about 2 years to get through the interconnection queue, and we're getting close to 4 years in the 2011 through 2021. And then we've got, of course, the Inflation Reduction Act, which is going to take and drive more. So as an industry, we really do need to focus on what can we do to get that backlog eliminated so we can get more generation in the ground and reducing carbon quicker and faster. But the quality of your pipeline is what's going to make the immediate difference. And then finding places to put in new projects is also critically important.
And what about you, Wyatt? PJM, MISO, or are you looking at Texas or California as well?
Yeah, look, we have a very diverse development pipeline. It's really throughout the U.S. But just to reemphasize what Jeff said, it all comes down to, in an environment where interconnection can be challenged, is quality of pipeline. And so going back to what I was mentioning around our solar developer that we acquired earlier this year, that was exactly the thing that excited us about that portfolio, is that it had a very robust pipeline in high quality markets like PJM, where the quality of site in terms of being able to get that interconnection in a very timely way was a very attractive part of that pipeline, and there were some other markets as well. So definitely, if you have quality pipeline, it is a huge advantage for your business, and we think we're fortunate enough to have that. The other area where we think some of those challenges around interconnections can be really impactful is on a distributed generation basis, where if the dynamics around distributed generation is that they basically price off an avoided cost. And if there's challenges around an increase in cost of transmission and distribution, that the economic incentive to do distributed generation only increases. And so we're definitely seeing a very robust growth on the distributed solar side of our business, because the economics of solar have only been getting cheaper, and that grid cost has only been going up because of some of the challenges around transmission and distribution. And then when you factor in that there's other suites of services, decarbonization services that we can add on a distributed basis, whether it's battery, whether it's energy efficiency, whether it's e-mobility, the growth of that business, just given the underlying economics of where solar is versus the alternative, and then the customer you have that you can then build from in terms of offering other suites of services is really meaningful. And so for us, we're very excited to have a very large, what we think is the largest distributed generation business in the US and globally, because the growth of that business will do really well in the environment that you mentioned.
Are you essentially talking about like virtual power plants, like finding a way to aggregate, or is that beyond that?
Yeah, look, the majority of our distributed generation is on site. So it's a mix. We have some rooftop, we have some ground mount, we do have some community solar as well. There's various ways that are going to be very dependent on the specifics of the market and the grid, but the ability to provide solar on a distributed basis, there's huge value to the offtake in that regard.
So what kind of returns, like return on equity, can you expect these days? Early in the pandemic and pre-pandemic, I'd heard like utility scale solar and wind was maybe single digits. But when we were speaking, Wyatt, earlier, you said that you like to go into the teens. What is it for utility scale projects versus, distributed generation and batteries?
Yeah, look, our target on these are equity returns, so after tax levered returns, is 12 to 15% and has always been 12 to 15% over the 30 years we've been investing in the renewable space. And fundamentally, that is what we would consider a premium to the broader market. But really what we focus on to earn those returns is focusing on areas where we're not competing on cost of capital. And one of the trends that we're seeing that is hugely advantage to large scale businesses like ours, and I'm sure Jeff would tell you the same thing, is if you can differentiate yourself on something that's not just cost of capital, i.e. if you have a global fleet that's across multiple technologies and you can provide an offtake with a wind plant in North America, a solar plant in the US, a large scale facility in China, India, that you really are differentiated, and there's incrementally a number of buyers who just given the drive to decarbonize, who are looking for large scale clean energy. These are the tech companies, what have you. And if you can provide those solutions and tailor a very bespoke solution for them, that means you're bringing something strategic to the table and you're not competing on cost of capital. And those are the areas that we focus in. In those areas, we're still able to achieve our 12 to 15% returns.
And Jeff, what are you chasing in terms of returns? And then are the big tech companies like your best friends right now for corporate PPAs, or are you finding new players come in?
Yeah, no, well, certainly the big tech companies are driving a lot of new PPA signing. And so if you look back to like 2005, 2006, there was very little activity on the corporate PPA front. And now you look at 2021, and I think there was 11 gigawatts of contracted contracts signed, and the typical names that you would expect in terms of Meta and Amazon and Google. And we're proud to have relationships with those tech companies and building our platform of corporate and industrial customers. It is really exciting to see them moving forward and see how they're driving the industry and giving the offtake that's required to make it take place and give the returns that would be consistent to what Wyatt is talking about. And to do that, you've got to be at the front of the curve. You need to identify the sites. You need to have a good relationship with the customer. And so there's a lot of the historic knowledge that we've built over the years and skill sets that we've built over the years that allow us to do that.